Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. April is Financial Literacy Month, and we will be covering a wide variety of topics to support the cause. Joining me is Caleb Silver, editor-in-chief at Investopedia, to discuss why interest rates are important to investors. And Caleb, let's discuss the effects certain areas of the market that are impacted by interest rates.
Sure. I mean, interest rates, you always hear about the stock market going up or down, maybe because rates were rising or there's a fear of interest rates or the Federal Reserve is meeting on interest rates. So what does that even mean? Well, what the Federal Reserve does is it sets the federal funds rate. This is the rate that banks loan to one another overnight. The Federal Reserve sets that, and a lot of interest rates are then based off of that. So when you get higher interest rates, that's good for banking institutions, which charge things like interest on your credit cards or on your loans. But when that happens, stocks, especially growth stocks, are really impacted by higher rates because they borrow a lot of money and their borrowing costs go up. So that's one of the principal ways in which interest rates affect stocks. And those are some of the key areas where you feel it the most.
And Caleb, let's talk about the basics of interest rates.
Sure. Again, it's interest rate for very basic terms. It's the amount charged on top of the principal by a lender to the borrower for the privilege of borrowing. So your car company, if you're financing a car, you're paying interest on that. If you're financing your home, you're paying interest on that. That's a form of interest. But the Fed, as I said, the Federal Reserve sets the overnight lending rate, which we sometimes refer to as interest rates, but really it's the overnight lending rate. And so many other financial instruments like the 10-year bond and others are based off of where the Fed sets its rates. So the Fed raises rates when it wants to keep the economy from overheating, and it lowers rates when the economy is in trouble. When we fell into a recession because of the pandemic in 2020, the Fed lowered the overnight lending rate to between 0 and 0.25%. That's almost as low as it can go to stimulate the economy, to get more borrowing, to make sure that money was available for folks that needed it. But higher interest rates, when they raise them back up or when they're coming back up, those can really impact the economy and economic activity. So everyone's really sensitive to the rise and fall of interest rates in the equities market and in other markets.
And we have seen the market chop as we're coming on the other side of the pandemic and the economy is starting to grow again. But at the end of the day, Caleb, aren't interest rates still at historically low levels?
Oh, yeah. Talk to anybody that was investing in the 60s and the 70s and the 80s, and they'll hit you upside the head if you start complaining about interest rates because they are very low and they've been very low for a long time. I don't know if some of your viewers may remember back in 2008, 2009, after that financial crisis, the Federal Reserve dropped interest rates back down to this very low level, near 0%, and that helped the economy recover. It took several years, but still interest rates have been down below 5% forever. If you look at these charts going back to the 50s and the 40s in the United States, interest rates soared during the 80s. Mortgage rates were 15%, which are based on interest rates. So interest rates have been very low, and that's been very good for equity and stock investors. And we've enjoyed a lot of bull markets between the 40s and 50s and today.
And of course, Caleb, it also impacts different sectors of the market, whether they're rising or falling.
Yeah, so like I mentioned earlier, banks, financial institutions, mortgage originators or mortgage company, they love higher rates because they get to charge you a little bit more. But even the credit card companies and the insurance companies that offer some of these lending products, they get to charge more in a rising rate environment. But when we have low rates, you get dividend paying sectors like REITs and utilities that do well because that's they deliver extra money to investors via those dividends. Growth stocks, which borrow a lot of money. So even the big tech companies that are very profitable borrow a lot of money. When rates are low, they want to borrow even more because it makes financial sense to them to go to the market for it. So they're highly leveraged. And when those rates go up, that hurts them. And then home builders like those low rates too, because when rates are low, we go out and we buy homes or refinance and get cash out of our homes. And then we put it back in and put a new kitchen in. So home builders and the home retail stores really like those low interest rates.
And as we have been discussing, the rise and fall of interest rates really can create some of that market choppiness that we've seen. What's the best way to invest when interest rates are in flux?
Yeah, so when rates are falling, you want to think about cyclical sectors that are going to benefit from that. So that could be like growth stocks or technology stocks that are going to do a lot of borrowing, or stocks that are in the home building area because those low rates stimulate home buying and home improvements. But you also want to look for momentum in companies that do the heavy borrowing so they can invest in their business for growth down the road. But when rates are rising, you want to get away from those companies with the high leverage. And we're already seeing that in the stock market now. Investors don't want to be around companies that have so much debt. When those interest rates rise, their cost of servicing that debt rises too, and that impacts profitability. So you want to stick away from those, but it's something to watch. And as we said, interest rates have been very low for a very long time, but even the slightest move these days is getting people's attention.
And to wrap up here, if we take a look at the past 10 years of growth versus value and that low interest rate environment, we can see that growth has outpaced value.
Right. And investors, especially those that have been in the game a long time, get frustrated by this. But low rates, which has been the environment we've been in for basically 20 to 30 years, have really done a great thing for growth investors and the companies that do that borrowing and that are highly levered, that have those big profit potentials. So growth stocks have dominated the stock market for the last decade, and who knows what's going to happen for the next decade. But with interest rates this low, it's hard not to see a continuation of a trend like this.
All right, Caleb, thanks for joining us for Financial Literacy Month. And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.